Welcome back to the podcast. This month, we're focusing on business owners and what they need to know when applying for finance, either for their home or their business. Whether you're running an established business or starting up a new business, we're going to dive into a few of the unique challenges that business owners face when it comes to applying for finance. So today, we've got Dylan joining me. Welcome, Dylan.
Thanks for having me.
Ready to get stuck into it?
Yeah, we got plenty of business clients and have worked with plenty over a long period of time, so there'll be plenty to cover today.
Awesome. Let's get into it. So I guess just as a bit of an overview, why is it harder or a bit more hoops to jump through for business owners when applying for finance?
Yeah, I wouldn't say it's harder, a little bit more complex and probably a little bit more to it. But I guess the thing is the bank's going to look into it a lot more. So whether it's, your entity that you've set up, if there is multiple entities, how that income is flowing through those entities, there's a little bit more to it. So we like to have an overarching view when we're looking at our business clients.
And it's different to, someone that works for an employer, isn't it? So, in terms of a home loan or an investment loan, is it purely just documentary that it is that's different?
Yeah, there's different documents that are required for business owners. And I guess because they're solely relying on the income from that business, which the owner operates, there's a few more questions that will be asked compared to someone that's just out in the workforce and has got a full-time guaranteed wage, right? Because the business and the fluctuations in that business can impact what income they have and how then therefore they can service their debt, whether it's for owner-occupied purposes or business purposes and investment properties as well.
Yeah, so you're saying that they obviously look into it a little bit more, and that makes sense, right? Because these might be smaller businesses, it's a bit more volatile. So if they're looking back in time, how far back do lenders look?
Your standard is 2 years. That's, across the board. However, the good thing is, having access to multiple lenders, up to, 40 on our panel. Some will just require most recent year, and they'll assess that in isolation as well. And sometimes if we provide a bit of commentary, we might be able to use forecast figures in some instances. There's also other lenders, maybe your second or your third tier, which will look at short-term income. So maybe potentially, what the last 2 or 3 quarters have looked like, and then we could project out, what we're forecasting the income to be as well. So a wide range of options for our business owners, which is important.
Yeah, absolutely. And in terms of, I guess, some key challenges self-employed clients face, we've talked about timing. Talk about some other challenges.
Yeah, timing is critical. So that's timing on how long you've been in the business, how long you've been operating for, how your cash flow is going, but also, timing and getting your documents completed in time for potentially applying for an application. So, being prepared is real important. And also, if you're starting out a business, things might not be going as well as they would be in 5 years' time. So being prepared when you're wanting to apply for finance or when you're thinking about applying for finance is really, really critical. So, talk to a broker, talk to your accountant, get ready and plan ahead.
Beautiful. We're going to go into specifically home loans now and getting a home loan as a business owner. So we're going to just go back to what you mentioned before with regards to timing and how far back they look. Can a business owner get a home loan if they've only been in business for 1 to 2 years?
Yeah, they can. So as we said, stock standard is, 2 years of company tax returns and financials. A lot of lenders will also want there to be 2 years of an ABN registration as well. However, as we said, some will look at it over 18 months or 12 months, as long as you've got that full year of financials that have been completed. So, if you're just starting out, there is going to be options for you. So don't rule it out.
And, this 2-year seems to be a common misconception among a lot of self-employed people and just people in the market in general. Well, I haven't been in business for 2 years, I can't get a home loan. But, like you said before, not even the 1 or 2 years, 6 months, you could potentially get a home loan. But do they come with a little bit more of a premium?
Yeah, they will. They come with a slightly higher interest rate or potentially some application fees as well. So there is some definite short-term options for clients that have just got started. So we weigh it up, the opportunity cost of potentially going out and buying that investment property or that home and paying that additional cost up front. Is it going to outweigh in the long run? So yeah, definitely don't rule it out. If you just started out or you've been in operation for a couple of years, there'll be options either way.
And that's a conversation that we have a lot with clients, especially the way the property markets are at the moment. Like you said, perfectly, opportunity costs. Is it worth just paying that little bit more in terms of fees and interest rates for the short term to get yourself into the market, and then you can always potentially refinance it.
Yeah, exactly right. So we'll get them in. It might be a case of they're with that lender for 12 to 18 months, couple of years, and we're looking and we're, planning and strategizing to get them out of that higher cost and into a mainstream lender within those couple of years. And then, usually in that case, the clients are very happy because they're best of both worlds. They've got the property and they're back out on much better terms within a couple of years.
So in terms of home loans, sticking to home loans, what are some of the most common mistakes we see with our self-employed clients?
Yeah, I guess and this is where it's really important we work hand in hand with the accountant, right? So, what might be on paper, the bank will view it in a different way. So, from an accounting and a tax point of view, there's reasons why accountants and business owners will structure things in a certain way, but that doesn't always, correlate to high borrowing capacity from a bank. So, when we are talking with our clients and they might be tax planning with their accountants, we'd always be more than happy to come in on that meeting and say, all right, the implications of reducing your income through expenses or whatever it might be means you're going to reduce your borrowing capacity. So I think we touched on it at the start is planning is critical for business owners, because if you want to be able to do both, it's adjusting for that expectation when you need to go out and borrow some money.
Yeah. And that's actually a perfect segue for this next little point is how do we actually strengthen their position? So you touched on planning, and okay, if you're planning on buying in the next 12 months, we need to make sure that your income is showing on paper, because that's ultimately what the banks look at. What other things can we do to strengthen their position?
So it might be a case of reviewing their existing business liabilities, seeing what's actually, with already in the business, and also what their projects or what their cash flow is looking like moving forward as their business grows. Are they expecting their revenue to increase? Are their expenses going to reduce because of, how they've set up their business? So, as we said, what's on paper, doesn't always correlate to high borrowing capacity. So making sure we plan for that, in time for that application when they're ready.
Yeah, absolutely. And it could also be, things like, are they paying themselves a wage, for example? Is that something that you need to start doing for a period of time? There's various ways, isn't there?
Yeah, there is. And that comes down to the lender. So they're different policies. So now, the lenders have expanded what income types they'll accept for self-employed people and business owners. So as you said, they might be paying themselves a salary and have been for a period of time, or they're planning to increase their salary. That will also affect how much they can borrow. And we can look to exclude anything in relation to the business. So the liabilities in the business and, the profit of the business, we don't need it. So that's one. Salary, are you going to continue to pay that salary ongoing? Are you planning on increasing that? Making sure that doesn't affect the performance of the business. So that's one way we can look at it. And then, some lenders will look at the most recent year in isolation. Some will look at 2 and use the average.
Yeah.
Or depending on the situation, if we know, there's potential increase in revenue and numbers coming forward, we might do some forecasting and use that with our banks.
Yeah. So touching on that policy is how different are self-employed policies from lender to lender?
Yeah, they can range quite a bit. As we said, we have, around 40 lenders that are on our panel, and they're not all the same. So, understanding what lenders are good at self-employed income and understanding their policy niches is really critical, because some businesses might have, significant liabilities due to how their business is set up. So we'll probably look to a lender that will exclude those liabilities if to improve their borrowing capacity. It might be a case of only certain lenders would do that salary only policy as well. So that's become more and more popular over the last few years, and the lenders have got a lot better at looking at it, but it's not a blanket rule. They don't all assess it the same. So understanding, the strength of that lender's self-employed policy is going to impact how much you can borrow as a business owner.
Yeah. And I think I really want to kind of delve on this point and focus on this point. Having the understanding and knowledge of self-employed policy across lenders is so important, right? Because in the instance where you've got someone that's got a lot of business liabilities at a lender that excludes them and uses the profit of their business versus a lender that includes the liabilities, we could be talking one lender is willing to lend someone $5 million and one lender won't lend them a cent. It's a huge difference.
And that, having that knowledge of the different policies, it's a flow-on effect with the client. Like having an understanding where we can go is going to make sure they can take those opportunities to grow their property portfolio, buy that dream home or buy that investment. So knowing the difference between all the lenders is critical to get that additional capacity.
Cool. So I think we've covered off pretty well the home loan side of things. Now, the other aspect of business owners and their requirement for funding is obviously for the business itself, right? And funding debt is widely seen as a great way to improve business performance. So, can you just talk about some of the options that are out there for business
So
owners?
some common facilities or, funding options that you might hear, is working capital, equipment finance, overdrafts. There's some ones that are out there that are quite common. But we can also see, business owners buying their premises for their business. So property finance, commercial property finance, which is also really common. And then also, we do see some business acquisition. So clients you might have an established business and want to link onto something else, or someone that's looking to get into business ownership and they want to acquire a business, there is also funding options to help assist with that acquisition. So, there's quite a few various options for them, but it also depends on what the purpose is and what it's needing to be used for will determine on what the terms are, what the facility type is, and, how we can best structure that.
Yeah. And those like working capital overdraft facilities that you mentioned, they're actually great ways to help businesses manage their cash flow and ultimately grow their business, isn't it? So, how do we kind of tie that in with their business strategy through their accountant?
Through the accountant, yeah, working hand in hand with the accountant is critical because we want to make sure any funding or whatever the purpose is for is also in line with their longer term strategy for the business. So, as a business owner, cash flow is really important. So having something like an overdraft can be really important as a bit of a buffer for businesses as they grow and as they expand.
Yeah, absolutely. So let's just say a business owner comes to you and they say, look, we're looking at getting some business finance. We won't touch on exactly what they're looking for. What makes that business attractive to a lender to give them money?
Yeah, so the bottom line obviously helps.
Of course, yeah.
Being a profitable business and having a profit margin there is really important. But also if there's any assets in the business on the balance sheet, so the banks will potentially want to use something as security. So depending what that might be, whether it's property as the commercial property or residential property, or if there's assets within the business, we could probably look at using some of that as well. So there's options out there. So I think it's just get in touch to see what's available, but also we would chat to the accountant about, all right, what are we actually looking to do? What do we need the funding for? And then we can sort of go to a lender, which we know will make sure that business looks attractive for them.
Cool. So now a business owner is thinking about getting finance. When should they come and sit down with their broker?
Yeah, as soon as possible. So we always say, look to apply for a finance, not when you need it, but when you can. So, if your financials is looking strong, get in touch with your broker and start to plan ahead because, most of the time when you need it pretty quickly. So having those facilities for our clients is, whether it's the overdraft as I said, for a buffer or, you might need to move pretty quickly to acquire on your premises. So being prepared with your accountant and being prepared with your broker can be the difference between you getting that property or getting that facility or getting that next project as well.
Yeah, absolutely. And just touching on that fact of getting the finance when you can and not when you need it. I think that's something that a lot of people don't necessarily focus on or pay attention on because with a lot of these facilities, you may not necessarily pay for them until you actually use them. So having them there ready to go it's
Critical and can make the difference between how your business can grow and how you get to the next stage. So having it available and ready is critical.
And again, going back to the point that, our focus is really dealing with the accountant and the client in conjunction, using bank funding and holding cash within the business is obviously another critical play because the interest should be tax deductible on any facility that you take out in the business.
Correct. Yeah. So there's benefits there of taking out some funding for the business and for business purposes.
Cool. So the next thing that we'll kind of touch on is the structuring of the debt. Now, this is again, and we're going to sound a bit like a broken record today, but there is a lot of work done with the client's advisors and accountants. Should business and personal loans be kept separate?
Yeah, it's an interesting question, and I think accountants going to get a good rap here. So we've raised them a fair few times in this discussion, which we just mentioned. But having a good advisor in your team and in your corner makes a massive difference. And that's where we'll sit down and have a discussion. All right, do we bring in personal stuff or do we keep it separate? There's definitely pros and cons to both. So I think it's case by case, depending on what you're looking to get out of it and I guess what your longer term plans are. So yeah, in some situations we would like to keep them completely separate, and that might be on the risk tolerance of our client, where they want to keep personal and business completely separate, which is fine. But then again, you might look to bring in your personal home as security, which therefore allows you to get better terms on the funding options, and you're comfortable with that. So I'd say it's case by case. And we, as I said, would work with that client so they understand what the implications are of having either personal stuff in or out.
And that's case by case because, we'll have an understanding of the client's business, historical performance, what are the plans moving forward, and then, because this is basically cross securitization that we're talking about.
Yeah.
If we're crossing, business facilities against their personal assets, having that understanding, would you say, then potentially make something less risky, right? In terms of, okay, well, it's quite unlikely given what we can forecast that that's going to happen.
Understanding their position.
Yeah.
So understanding what their position looks like, how they're expecting the performance will be over the next few years, and then we weigh out whether it's worthwhile or not. So, yeah, as I said, there's a fair bit to it, but case by case and understanding what their position looks like.
Yeah. And again, just on that, a lot of clients that we work with, there might be a husband and wife where the husband's the sole director of the business, and the wife might be the owner of the home. So again, keeping things separate from a business and personal perspective, but it just really depends, doesn't it?
Asset protection. So we see various types of structures. As you mentioned, the ownership of the business is in one, and then the ownership of the personal stuff is in the other. And then we sort of get into it a bit further as to how we actually structure and the different entities of that business and what impact that makes as well. So there's thousands of different ways to do it, right? But obviously how it's set up and narrows down to what lenders we can go to. So, different entities will be set up for different purposes, whether that's the entity for the company itself, and then accountant might set up a separate entity for the property as well. So, lots of ways to structure it.
So going to the entities, how does that actually impact the application of the loan?
Yeah, it can, because I guess at the end of the day, the bank's going to want to use income from somewhere. So if it's the main trading entity, we'll usually lean on that. If it's set up as a company, for example, then we might be able to utilize the performance of that business and look to exclude all personal income positions and personal assets.
Yeah.
If you're a sole trader, for example, and everything's in your individual name, we'll have to take into account your whole personal position. So the different structures and the different entities can impact what we will rely on from a servicing point of view, but also from an asset point of view as well. So we might look to separate it by creating these separate entities with the accountant.
And this is actually where you raise a good point. This is actually where applying for business finance and personal finance, there is a bit of an overlap because every lender is going to have different policies. So again, having that preparation and saying, right, this is my plan, then okay, maybe this should be set up in X entity because that's going to maximize your borrowing capacity for what you're looking to do. So again, without sounding like a broken record, it's planning when it comes to business finance.
Which can be hard at times, right? Because we're all in our everyday lives trying to run our businesses or try to do what we do.
Yeah.
But sitting down with your advisor and sitting down with your broker is really important, because you want to get it right. You don't want to get it to a stage where it's messy and it's not set up the right way, because it can be quite hard to unwind that. So getting it set up correct at the start and planning ahead is really, really important.
I'm going to put you on the spot here. So we've been talking a lot about planning ahead, and we've spoken about sitting down with your broker, sitting down with your accountant. That aside, how else can a business owner plan ahead?
Well, I guess bit personal stuff as well. So understanding what they want to get out of any transaction. So it's always a hard one, right? Like things can change, and personal plans can change, and business plans can change. But most common thing is, when you've got your financials done, reach out to your broker and have an understanding of what that looks like and how that can improve your capacity, because then that will help you plan what you're going to do for the year for the business. If you are looking at acquiring property or acquiring, employees and want to have a bit of a buffer there with an overdraft, just reach out to them and have that conversation, because, we deal with our clients day in, day out, whether it's for their personal stuff and for their property stuff, or if it's related to their business. We have a fair understanding of what their situation looks like. So just give them a call, give the broker a call. And then that way, where you set, and then you can plan for your business for that year.
Awesome. Thanks, Stu. I think we're just out of time. But before we go, what's your one piece of advice for business owners who may be looking at buying a home, investment property, looking for an overdraft, looking for a commercial property.
Have good advisors in your corner. So it's a pretty generic one.
Yeah.
But have a good broker and have a good accountant who are happy to talk to each other, because then we can all sit down and strategize for what your plans might be for that year, but also for years moving forward.
And I also just want to kind of add on to that, something that we talk about outside of this as well is the minimizing tax. That's something that we see all the time. But if you've got plans, maybe that's something that you need to have a think about as well.
Yeah, exactly right. Makes a big difference.
Beautiful. That's all we have time for now. Dyl, thanks for joining me.
Thanks for having me.
And thanks to everyone for watching.